Hi, everybody. So today I want to talk about dividend investing and more specifically REITs. So what is a REIT? I'm just going to give you the straight up definition from Investopedia. It is a real estate investment trust, and it's basically a company that owns, operates, or finances income generating real estate. So what are the properties of a REIT? I'm going to scroll down here. We see that they need to invest at least 75% of their total assets in real estate, cash, or US Treasuries. They derive at least 75% of gross income from rents, interest, or mortgages that finance real property or real estate sales. And this is the big one. They pay a minimum of 90% of taxable income in the form of shareholder dividends each year. So here is an example of a REIT. It's called Realty Income Corporation. Now, full disclosure, I don't own this company, nor am I recommending that you buy this company. This is just an example. So, one of the most important things I like to look at is consistency in a company's dividend. So, let's go ahead and look at that. So, here in the search bar, I'm typing Realty Income Dividend History. And I guess I could find this information straight from their company website. So let's go ahead and look at that. So here you could see that every month they're actually paying out a dividend of about 24 cents. And you can see that they've been consistently doing this for a while. And if we go all the way to the beginning, well, maybe not all the way to the beginning because this is a lot of dividend history, you can see that every month they're paying a dividend. It's actually increasing ever so slightly. So you can see in 2011 it was 14 cents. 2012 it was around 14 cents also. 15 cents, 18 cents. So you want to see a company that is consistently paying out dividends and their dividend is increasing. Now you want to be very careful because sometimes a company dividend just increases massively. So you want to think what happened. Well, what can happen sometimes is that a company can do a reverse split, and they could merge shares together. So in that manner, a company dividend can either increase significantly or decrease significantly. So you want to pay attention to that. Or if they're a good company, they're just increasing dividends so fast because they're earning so much money and they're just rewarding shareholders. So you can kind of see how this dividend has evolved over time. It's basically doubled since the 2011 area. And finally, we're right here and we're paying about 24 cents every month. And what we want to pay attention to is this ex dividend date. So essentially, we have to hold the stock through this date to receive this 24-cent dividend. So this is actually coming up at the end of the month here. So if I hold Reality Income stock through the end of 2022, February 28th, then I will be rewarded 24 cents per share. So the next thing we want to do is we want to calculate what the dividend yield is. So dividend yield, the way that you calculate this is the annual dividend divided by the current share price. So we can go ahead and calculate that. So let's do 0.2465. Let's multiply that by 12. That's about almost like a $3 dividend. And we can see right here the current stock price is 67.40. Divide that by 67.4 is equal to this number. We want to multiply this by 100 because it's a percentage. So that's about 4.38. And if we round that up, that's 4.39. Right here, it says dividend yield 4.39. So this is pretty up to date right here. So basically you're getting a 4.39% return on your investment here if you were to purchase it at this price right here. So the way you need to think about dividend yield is that as the stock price falls lower, your dividend yield becomes higher. So let's say, for example, Realty Income dropped to $60. Then what becomes our dividend yield then? We could recalculate that. So the way that we recalculate that is that we basically do that same format again. We do 0.2465 times that by 12. That's our yearly dividend. And then we divide that by a stock price of 60. And at that point, we basically get 4.93% on our return if we were to buy it at $60. So this is how you do dividend yield calculations. Now, a lot of people just talk about the dividend yield all the time and they don't really tell you about the company. What is the company doing? So let's just kind of look around this website for a little bit. Let's look at their portfolio. So let's look at their top 20 clients. So this company has a bunch of leases for Walgreens, Dollar General, 7-Eleven, FedEx, and let's see, Lifetime Fitness. So a lot of companies, pretty popular ones, AMC Theaters. So they basically own all these properties and they are just collecting revenues from rent. Now we're going to go into the financials here. So here I'm on Yahoo Finance. I looked up the ticker symbol O. So let me just do this from scratch again. Realty Income. Then I'm going to go to financials right here. And then what I want to look at is the income statement, balance sheet, and cash flow. So let's just look at this real quick. So you can see year over year, their revenues have been increasing. Obviously, the cost of revenue is increasing as well. And the gross profit numbers, well, yeah, they're definitely increasing. You could see that clear distinction here to here from 2020 to 2021. And one of the key things you want to pay attention to is depreciation and amortization. Now, think about this for a while. This company owns a lot of properties. So there's a lot of money going out in depreciation expense. So remember, depreciation and amortization are not cash expenses. So this expense right here is not actually money coming out of their pockets. This is just something that is reported on the income statement because this is accrual accounting. So their bottom line right here actually shows 716, and keep in mind this is all in thousands. So this is 716 million. But if you look at their earnings before income tax, depreciation, amortization, this amount is actually a lot higher. But this is what they're getting taxed on because it's earnings before income tax. So they're getting taxed on this amount right here. So just keep that in mind. And we want to pay attention to their cash flow. Now, a company is paying you dividends every month. Now, what you want to see is a company that has consistent cash flows that is definitely positive. So if we look down here, we could see 2018, 2019, 2020. Now we see that this cash flow is increasing and it's pretty consistent. You know, there's not massive fluctuations. For a company that's paying dividends, you want it to be pretty boring. You want their income flow to be very steady. You don't want to see massive fluctuations because to me, I just want a stock that's boring, that's paying dividends. I don't want anything exciting. You know, I don't want something like Tesla or whatever. Like this can just be a very boring stock and it just has to pay me dividends every month. So yeah, we could see free cash flow is definitely good. And then when you look at the cash flow statement, you can see that they're adding back depreciation and amortization because that is not a cash expense, you guys. So let's go back to their balance sheet. Let's just kind of take a look at their current assets to current liabilities. So let's see. So you can see they actually have a lot of current debt here. And you can see that their cash and cash equivalents are actually not that high. So if we're looking at this number right here, we're comparing that 715 to this number right here. So clearly they're doing something different in 2021 because this number is much higher. So that's something we would want to look into. So yeah, you can see that they took out a line of credit. And then let's also look at their ordinary share number. So you can also see that in recent years, this number increased quite a bit. Ultimately, what's important is that their cash flow is consistently growing. They have more than enough money to pay this dividend. I mean, we could go to the financing cash flow and we could see what they're actually paying here in dividends. Now, they're obligated to pay 90% in dividends of what their taxable income is. So clearly here, they're actually paying a lot more in dividends than what their taxable income actually states. So their taxable income is this right here. So they're paying over 100%. But keep in mind, you guys, remember I told you that depreciation is not a cash expense. So this number is actually understated if we're talking about how much they earn. Because this number right here is probably more in line of what they actually earn because we're not including that depreciation or amortization. So yeah, we're going to go back here. We're going to look at that financing cash flow. And we see that they've been paying their dividends. And ultimately, we have good cash flow right here. So remember, guys, I'm not saying go and buy Realty Income right now because that's I'm just here talking about dividend stocks. And one thing you have to keep in mind just before I leave is you have to think about we're in an interest rate environment where interest rates are increasing. So does that 4% something dividend, is that worth it? Because in the future, if interest rates are rising, are people going to get better returns somewhere else that's a little bit safer than in the stock market in these dividend stocks? So that's basically it for dividend investing, you guys. Make sure you're paying attention to the cash flow, their debt obligations, and just what they make in general. So that's it for that's it. I hope you guys enjoyed.